Good afternoon. Today we're going to talk about the standard unmodified audit report. Remember, we're in chapter 1, uh, day 1. So this is not something you have to master today. Chapter 3, the entire chapter is on audit reporting. But I'm trying to sell something here. So bear with me and we'll go through the standard unmodified audit report. And you'll see there's 4 sections. There's the opinion, the basis for opinion, responsibilities of management, and the auditor's responsibilities. So those are the 4 basic sections of the standard audit report on standard unmodified opinion. So in the opinion, people complain about memorization. We have audited the financial statements of. Now, most all of you have had 214, 321, 322, so you know what the financial statements are, which comprise the balance sheet as of 12/31, the income statement, statement of retained earnings, and statement of cash flows for the year then ended, and the related footnote disclosures. So we know that. We know that the financial statements are comprised of income statement, balance sheet, statement of retained earnings, statement of cash flows, and the related footnote disclosures. We also know by now that the balance sheet is as of December 31st, and the income statement, statement of retained earnings, and statement of cash flows are for the year then ended. So, to me, all you have to learn is we have audited the financial statements of. The rest you already know. In our opinion, this is big. In our opinion, the accompanying financial statements, those referred to in the first paragraph, present fairly in all material respects the financial position of ABC Company as of December 31st and the results of its operations and its cash flows for the year then ended in accordance with generally accepted accounting principles. Okay, so there's a bunch of words there, but in our opinion, all opinions, not all reports, but all opinions start out, in our opinion, the financial statements present fairly in all material respects. What do they present? The balance sheet, the income statement, the statement of retained earnings, the statement of cash flows. But old people are no different than young people. They hate to use the same words over and over again. So instead of saying the balance sheet, they say financial position as of December 31st. When I was a student, the balance sheet was often referred to as the statement of financial position. The results of operations and cash flows for the year then ended. That's the same thing as saying the income statement and statement of cash flows. I don't know what happened to the statement of retained earnings. I'm not worried about it. Okay, so again, there's a lot of words, but I don't think there's that much memorization to learn those 2 paragraphs. 2 paragraphs in the opinion section. Now, I'm going to be guilty of talking about the opinion paragraph, the basis for opinion paragraph, the responsibilities. There should be sections, so I should refer to the opinion section, the basis for opinion section. If I slip up, be patient. I'm old. The basis for opinion section. There's 2 pieces. Notice they're green because they're really important. We conducted our audit in accordance with generally accepted auditing standards. If not, we got a big problem, right? So we start out, we conducted our audit in accordance with generally accepted auditing standards. And then we end up, remember I've said before, efficient appropriate audit evidence is a huge concept. The last sentence is, we believe that our audit evidence is sufficient and appropriate to provide a basis for our opinion. If we can't say that, we don't have enough evidence to express an opinion. Okay, so that's why those 2 lines are highlighted in green. What's green mean? Oh, I better know that for the test. Then management's responsibility should be familiar with it. Don't have to memorize it. But it's important for you to understand that Management is responsible for the financial statements, period. One of my favorite audit partners used to laugh and he said, when I'm training new partners, I have to stress, don't accept responsibility for the financial statements. He says, young partners and young managers come to me and they say, oh, we got a problem because their financial statements contain a material misstatement. And his response, he said, was, no, we do not have a problem. They have a problem. They're their financial statements. They're not our financial statements. Okay. So never accept responsibility. If the financial statements contain material misstatements, that's the client's problem. That's not your problem. Then I've got a little lighter down there, raise substantial doubt about ABC's company to continue as a going concern. Just highlighting, that'll come up in chapter 3 again. So what I'm trying to stress here is there's a lot of important words in this opinion, and they relate to our definitions and our audit objectives. They flow through the whole course. Auditor's Responsibility section. Our objectives are obtain reasonable assurance about whether the financial statements as a whole are free of material misstatement, whether due to fraud or error, and to issue an auditor's report that includes our opinion. Wow, that's almost the same as Audit Objective 200. I mean, when I look at 200 here, I wouldn't know the difference. Obtain reasonable assurance about whether the financial statements as a whole are free of material misstatement, whether due to fraud or error. Enabling the auditor to express an opinion on whether the financial statements are presented fairly and all. Not quite the same, but almost the same. And I'm going to let you in on a secret. I'm not trying to get 100. I'm trying to get an A on the test. So initially, I'm going to treat this first sentence and 200 the same. I'm going to learn one or the other. I'll probably learn this first sentence because it's shorter. And then if Tad asks me Audit Objective 200 on the test, I'll just regurgitate this. No, and I may not get full credit. I may only get 4 points out of 5 or something, but I'll be close. He knows I pretty much know it. Then here's the definition of reasonable assurance, a high but not absolute level of assurance, and it's not a guarantee. This is later on, we'll emphasize or learn that the risk of not detecting a material misstatement resulting from fraud is higher than the risk of one resulting from error. It may be more difficult to detect a fraud because management or somebody is intentionally trying to hide it from us. Whereas errors, management often will help us find the errors. Here's a definition of materiality. Misstatements are considered material individually or in aggregate. They could reasonably be expected to influence the economic decisions of users made on the basis of these financial statements. So misstatements are material if they could be reasonably be expected to influence the economic decisions of somebody relying on these financial statements. And then I see professional skepticism in lavender. That's a biggie. We'll have to learn that for the first test. Exercise professional judgment and maintain professional skepticism. Professional skepticism is a big word. Identify and assess the risk of material. Where have I seen that before? That's 315, isn't it? Okay, and then the next paragraph in lavender, obtain an understanding. That's 315, right? Okay, then there's kind of Tad's pet peeve here in yellow. It seems to me that we say we audit 5 things. Examining such procedures include examining on a test basis evidence regarding the amounts in the financial statements and the disclosures in the financial statements. I count that as 2. You might count it as 1. Then the next yellow, evaluate the appropriateness of the accounting policies used and the reasonableness of the significant estimates made by management, as well as evaluating the overall presentation. Okay, so to me, there's 5 things we say: the amounts in the financial statements, the disclosures in the financial statements, the appropriate of the accounting policies used, the reasonableness of the significant estimates made by management, and the overall financial statement presentation. Then in lavender, again, I got that substantial doubt about the abilities of the company to continue as a going concern. And again, we'll hit that a little bit in chapter 3. So hopefully you're seeing how a lot of these terms flow through, okay, from the objectives into the report. And this is for the last chapter. We're required to communicate with those charged with governance regarding matters related to the internal controls. Okay, so that's for way later in the quarter, but it's in the report. Just want you to see how these things tied. And look, as you go through the course, rather than just memorizing things, see if you can figure out how things tie together. Okay, so here's what the book says. A misstatement is material if knowledge in the misstatement will affect the decision of a reasonable user of the financial statement. So that's where we're at right now. Materiality is, will it affect the decision of a reasonable user of the financial statements? Auditing standards have a bigger definition, but we'll stick with the short one for now. The magnitude of an omission of a misstatement of accounting information that in light of surrounding circumstances makes it probable judgment of a reasonable person relying on the information would have been changed or influenced by the misstatement or omission. So that's the longer definition, but we're going to be happy to learn the short one for now. Maybe we'll come back and learn the long one later. That's all I have for today, but I've got a little bit more to wrap up in chapter 1. So I'll see you later today or tomorrow.